Hello, and welcome to Money Maximized. Today, we are going to talk about debt-to-asset ratio. The debt-to-asset ratio is a financial metric used to assess a company's financial leverage and risk. It is calculated by dividing a company's total debt by its total assets. Here's a breakdown of the key components. Total debt. This represents all of the company's outstanding debt obligations, including both short-term and long-term debt. It includes loans, bonds, and other forms of borrowing. Total assets. This represents the total value of all the assets owned by the company. Assets can include cash, accounts receivable, inventory, property, equipment, and investments. The debt-to-asset ratio provides insight into how a company is financing its operations and investments. A high debt-to-asset ratio indicates that a significant portion of the company's assets are funded by debt, which can increase financial risk. Conversely, a low debt-to-asset ratio suggests that the company relies less on debt for financing and may be in a stronger financial position. Here's what different debt-to-asset ratio ranges typically indicate. Low ratio, less than 0.5. A low ratio suggests that the company has a conservative approach to financing and is less reliant on debt. This can be seen as a positive sign of financial stability. Moderate ratio, 0.5 to 0.7. A moderate ratio indicates that the company uses a reasonable amount of debt relative to its assets. This is a common range for many companies. High ratio, greater than 0.7. A high ratio indicates that a significant portion of the company's assets are financed by debt. While this can be beneficial for leveraging investments, it also increases financial risk. It's important to note that the ideal debt-to-asset ratio can vary depending on the industry and the company's specific circumstances. Some industries naturally have higher ratios due to the nature of their business, while others are expected to maintain lower ratios to reduce financial risk. Investors, creditors, and analysts use the debt-to-asset ratio to assess a company's financial health and risk profile when making investment decisions or evaluating creditworthiness. A low or declining ratio may be viewed positively, while a high or increasing ratio may raise concerns about a company's ability to manage its debt obligations. Thanks for watching, and don't forget to like, share, and subscribe.